There's always something to buy. We never give in to the noise. We never give in to the rhetoric.
Bullish Brian Belski isn't blinking. Iran war volatility won't keep him out of the market.
United States stock market is the best stock market in the world. Canada, we believe, is still second to the US.
After a 30-year career working at various financial institutions, he struck out on his own 6 months ago, launching Humilis Investment Management with an emphasis on stock picking.
I don't believe that Canadian people own enough Aritzia. I bought Spotify all these years ago. Bonus pick, Spotify.
But there are some areas that he is nervous about.
We've been very vocally negative, private equity and private credit.
Does it get much worse?
It's just reminiscent of 2008.
Tell me why you're neutral on gold. Talk to me about how you manage this volatile period.
Brian, I see you on TV and I trust you have a kind face.
Sorry. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we talk about Meta, Nike, CNQ, and Apple, which are all stocks that I own. Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. Well, it is very clear that the Iran war is still dominating the discourse for investors, whether there is a ceasefire announcement and that sparking a rally or concerns that maybe that ceasefire is not being honored. It's still very much top of mind. Except in this interview, we spoke with Brian Belski. He is a longtime strategist turned fund manager as of 6 months ago, his own fund, Humilis Investment Management. And that now means that he can talk a lot more freely than maybe he could when he worked at a bank, and he is solely focused on stock picking. And in this environment, he's a buyer. He's still bullish. He's still bullish America. He likes the Canadian markets too, not necessarily gold, but loves the energy stocks. But he is viewing any volatility around this as a buying opportunity in certain select sectors. Now, what's interesting about Brian coming on now is he came on about 9 months ago, and this was sort of the post-Liberation Day time. And he was kind of saying the same thing. Everybody was very anxious about tariffs. And he said, I'm not changing a thing. I'm still buying. And the markets over the last year are up about 50%, both in the US and Canada. So that turned out to be the right call. War obviously sounds more severe and is more severe. And once again, he's looking at things like earnings growth, things like multiples to guide him from outside of what's going on in the headlines. Again, we've talked about this a lot. What makes headlines doesn't necessarily make money. And Brian says he's focused on making money. So let's see if we can do that. Let's get into it. Okay, Brian Belski, thank you so much for rejoining me on the podcast.
Amber, honestly, oh my gosh, it's been too long. Let's just establish that first. Way too long.
I know I do need more Belski in my life because you have a contagious, I think I have toxic positivity, but yours is like radioactive positivity.
You know, I'm so glad you brought that up because people always accuse us of being stubborn, and flippantly bullish and positive. But when you branch off on your own, and hopefully you get a chance to talk about that, I've heard from brokers, as we still call them, that I used to work with at firms like Dane Bosworth and Piper Jaffray, but Merrill Lynch. And I had the really good fortune of doing a speech my very first day on my own, October 29th of 2025 in Minneapolis. And President Bush followed me. And I got up on stage and I was talking about stuff. And I got off stage and this gentleman came up to me and he grabs me by the shoulders and he goes, Belski. And I said, you're from Merrill Lynch. And he goes, how do you remember me? I said, that's what I do. I'm really good with faces, not good with names. And he grabs my shoulders, Amber, and he says to me, he goes, I just got to tell you, Belski, you saved my career in 2008.
Why?
Because I got him out of the market and I got him into the right stocks. And so he said, you transformed my business, transformed my life. And I think, we're going to talk about Humilis and humility and everything. You forget sometimes what you do for people because you're just in the trenches and you go, go, go. So that was like, God put that right in front of me right away and like was a hit right between the eyes. But going back to being bullish, there's always something to buy in equities. And even when we're negative, and there have been times when we're negative, there's stuff to buy still. And so that's really what we've based our career on.
And we're going to pick away at that, but let's spend a moment on this kind of transformation that you've gone under, not just your tan.
Come on.
I had to.
So many people say there's no transformation. It's always tan. Don't judge me.
I know, that's true. Even in Minneapolis, somehow you were the most tan guy in Minneapolis.
Wow.
But now you live in Florida, so it explains why you're so tan, darker than me in April. The last time we spoke, you worked at a bank. This is the first, and you've worked at various banks throughout your career.
Yep.
This is the first time you've completely struck out on your own. You're managing your own funds under Humilis, which means humble. Talk to me about that decision and what you can do now that maybe you were never able to do.
Well, it's equal parts exhilarating and excruciating.
Yeah.
36 years I worked for the man. And by the way, there's some good parts working for the man, like compliance and paperwork and all that kind of stuff, which I've never claimed to be the smartest person in the room, and I've never claimed to be the best at everything. I'm not good at that stuff. And so what I'm good at, I think, is talking to people about their stocks and their investment and explain the market to them. So what's very different is I'm making decisions on behalf of Humilis, Brian Belski, and our team. I don't have other things I have to worry about. Like at my last employer, I had 3 jobs: head of U.S. strategy, head of Canadian strategy, and ran this portfolio business that ran separately managed accounts and ETFs and mutual funds inside of capital markets for the wealth platform. So when you work for a big platform like that, you really answer to everybody, whether that's the consumer bank, the commercial bank, the investment bank, or the wealth channel. So we're pulled a lot of different directions. And oh, by the way, that really was something that defined our career through whether or not that was Merrill Lynch or Dane Bosworth or Piper Jaffray or other places that we've been. So let's go back on what is different now is that now I can just focus on the investing, right? I don't have to focus on walking into JP Morgan on Park Avenue in New York to sometimes argue with portfolio managers that, oh, by the way, own 150 or 200 stocks that have no conviction, that are just doing that to kind of get by and try to beat the market. That's where our tagline comes in terms of how we think about things. We invest with conviction and humility. Conviction means we own 50 stocks in our large cap portfolios and 60 to 75 in our small cap portfolios. That's pretty convicted relative to, let's say, the institutional world that are traditional portfolio managers that probably were analysts first on the buy side. Then they were an assistant portfolio manager, now a portfolio manager. Now they're out in the hintersphere talking stocks. And I've been in front of crowds and doing talking and explaining the stock market since probably before you were born in the early 90s.
I mean,
Own it.
I'm quite young. Own it. Yeah. Now that I have all the gray hairs, I want to be thought of as,
So we've been doing this for a long time.
Yeah.
And you just don't buy something from someone because they've been doing it for a long time. You do it because of their process and their discipline and their conviction and their consistency, all things that we've shown people through the years.
So conviction, you don't have a massive, not 100 stocks. You said 50, but you do have a bunch of funds. How many total? 4?
We have 8. We run 8 separately managed account portfolios, 3 that are North American, so partial Canadian, partial US, and then 5 US-centric portfolios. And so it was important to team with great partners here in Canada and establish the Canadian business. And we have some more business coming our way, and we're going to make some more announcements here soon. And then, we were working for a US bank for 22 years before we came to Canada.
Yeah.
So I think a lot of people forget that we're American. And I don't take offense to that. I take credit for that because I spent a lot of time in Canada. And being born and raised in Minnesota, I play it up, sometimes when I'm in certain places. And so a lot of people think we're Canadian. And I always pay homage to Canada because we have and had amazing clients here. So I think the U.S. is really going to be the growth engine, and we're going to be rolling out ETFs, and we already have our SMA business and platforms there as well.
Okay, so that's the new Brian Belski. You can focus just on investments, less on maybe the other parts that you had to do when you worked at the bank. So let's talk about these investments now. Let's get into the fun stuff. We came through a very anxious March where war was looming large over the markets. And I believe during that period, you were still as Pollyanna as you are today. Pollyanna-ish, saying buy. And the markets want the war to be over. You can see that this week when Trump, I guess, extended the end of civilization by another 2 weeks. The markets just rip higher. Talk to me about how you manage this volatile period, because it seems like war on, markets down, war off, markets up.
Same way we always have. Last April, when we were at our previous employer, we wrote I think now relatively famous report where we said, we're not changing anything. We own what we own.
And that was the tariff scare last year.
That was Liberation Day, the tariff scare, where many Canadian clients, unfortunately, led with their emotions and their fears and left the United States and they had a great year in Canada. It was fantastic. But that can't continue and hasn't continued, by the way. And so we always default to fundamentals. We always default to the longer term. We never give in to the noise. We never give in to the rhetoric. And because of that, you may go through a January and February like we did, which wasn't great. March, we absolutely crushed it across the board in terms of our portfolios because we stuck with our conviction. Now you have a day like today where it's, silliness. It's up 4 or 5%. But we don't manage money based on a month or a quarter or a day. We manage money always looking out 12 to 18 months, always thematic, always fundamental, always top down. Now, not top down looking at economic statistics, but top down these models that I originally built. Don't laugh. Like 1993, 94. And from looking at the markets, sectors, industries, and now I have much smarter people. And I've had one gentleman next year, Amber, he's been working with me for 20 years.
Wow.
Think about that poor guy. Anyway, amazing man in person. But my team has been able through the years, and the teams that I've hired, been able to take my models and what I originally thought and break them into and put them into these amazing formulas and all this kind of stuff that they're way smarter than I am. But we look at earnings and valuation levels and operating performance. What's operating performance? Things like return on equity, return on assets, EBITDA, and then important technical measures in terms of performance, not technical charts, but is it going up? Is it going down? Does it look relative to the industry and the sector? And we incorporate that all from a top down into the bottoms up in terms of the actual stories. And then we also kind of think about events or fundamental operational issues. And that's how we look into things.
Good insight into how the sausage is made. When you put it all together, looking 12 to 18 months, why are you still constructive?
United States stock market is the best stock market in the world. And by the way, it proved it year to date because it's one of the best performing markets in the world.
United States?
Yep.
Not compared to Canada.
Canada, yeah.
Not compared to the UK.
Well, look at UK.
Not compared to Japan.
Oh, look at you in the developed markets, okay? Well, look at emerging markets getting crushed, right?
Okay, but that's not like
Well, a lot of money left last year and went to emerging markets, right? Canada, we believe, is still second to the U.S. But given the fact on what gold has done, okay, God bless you, it's been amazing. been an amazing run. Doesn't mean sell all your gold, just means that don't chase it. The banks, amazing year last year, right? We wrote a number of years ago that the banks in Canada were poised to outperform for a several year period because they over-reserved. If you go back 200 years of data in Canada, you can see anytime the banks over-reserve, which they did in 22 and 21, 22, and 23, ushered in this massive outperformance. Can't continue. So Canada has best relative and absolute outperformance of the U.S. last year in local currency since 1990. We know that. That's great. But given the less diversification of the Canadian market relative to the U.S., and given everybody trying to chase gold and loving gold, I'm more worried about that. Doesn't mean it can't be positive. It just means that I think it's going to underperform.
I want to talk to you about gold because you haven't been there for the rally and you don't recommend chasing it now. So I want to...
Oh, we've been there for the rally.
Okay, but you're not there now.
No, we own some gold stocks, but we're not overweight.
You're not overweight. Okay, well, that's also something. That's a choice given how well gold is done. But I'm going to poke you a little bit more on the U.S., being, the great dominant market that it's really been for the last 15 years. It's been the place to invest. And on this show, many times we have investors saying it's changing now. There are periods of years of U.S. underperformance, and we're just in for one of those periods. One, because the U.S. market is expensive relative to other markets. It still has a bit of an inflation problem. Tech is struggling, right? Not the businesses themselves, but the stocks just aren't going up. And in some areas, they're in an outright correction. And you just have other more diversified opportunities outside of the U.S. Which one do you want to tackle first?
Well, anyway, thank you for the consensus call there. I really appreciate that. I love to go against consensus. People think I'm momentum positive, but I'm actually contrarian. So first off, let's talk about tech. We in our work and our former employer, even now, we're underweight the Mag 7. And that's helped us to outperform. Why? Because there's this thing called dispersion. What's dispersion? It means that things are trading on a technical, fundamental basis very differently within tech. Even look at the Mag 7, they're very different. And so we saw that heading into the end of last year, and we've incorporated that into our portfolios. So you don't have to own everything. We're actually net neutral tech for the first time since 2022.
And putting that where?
Communication services, financials.
Is that telecom? Because I think Meta is in communication services.
Yeah, we haven't owned Meta. We have not owned Meta since 2018.
Oh my gosh.
And we've outperformed. You know why? Because Google's a better company in our view. And we can hopefully talk about that.
We'll talk about that, yeah.
Anyway, utilities. We think utilities is a backdoor play to play AI. Well, we can get to that. So tech is not going to be as dominant. Oh, by the way, we're heading into, and we wrote about this in our year ahead piece for 2026, we're heading into an earnings-driven market. By the way, we've had a massive multiple compression this quarter, so you may want to check your data relative to the rest of the world. Japan, by the way, had a big run last year, and they've got some issues in terms of what they're doing with their currency and inflation. The UK has some issues with their own currency, and what do they make over there? At the end of the day, what do they make? So at the end, I want to look for companies and countries where I know what the stocks are, not just buying the country, okay? Now, on going back to the U.S., we believe that, and this is contrarian all of a sudden, that we're going to continue to see a broadening out of the market. When earnings-driven markets occur as part of this big bull market, and our call has been since 2009 in print and the published on the public marketplace, that we're in a 25-year secular bull market, and Canada's come along for the ride. But we do believe that in earnings-driven markets, the year-over-year price percentage is actually half of what momentum-driven markets and multiple-driven markets, multiple expansion markets, which we've clearly been in since October of 2022, okay? Now, as we start to see differentiation, not all tech stocks are created equal. We're seeing that clearly in financials. We're seeing it in consumer land, industrial. So stock picking, differentiation, dispersion, that benefits the United States because we have more diverse markets. We're not as cyclical as Canada. We're not so dominated by 3 sectors in Canada or 8 stocks. We have 500 stocks in the S&P 500. By the way,
half, you could argue half is tied tied to tech.
No, half.
At least 30%.
Well, I'll take 30. Well, 30%. Well, not anymore. Now, the tech weighting is in the upper 20s, which is good. Oh, by the way, here's a prediction. I think within 5 years, maybe 3 years, the agencies, whether or not it's S&P or Russell or Morgan Stanley, MSCI, they're going to split the tech sector into two.
And what will that mean for the weighting?
It'll go like 15%, 15%. That'd be good.
How are they going to do that?
Well, they can easily do that. They can do AI, or they can talk about services versus software, hardware versus... You watch. Write that down, everybody. Write that down. Anyway, so I think that benefits the U.S. in terms of diversification. What we've also learned, too, is that it's not all about AI.
Yeah.
It's not all about AI. And I think that's going to be a big, big thing that'll help benefit the U.S.
I want to pick on two things, because you're right. In some ways, it was consensus to no longer be into tech. It took a while, and now you can get Microsoft, you can get Meta, which I can't believe you haven't owned since 2018, at lower than market multiples. Is now the time to go back to some of these names? You were underweight the Mag 7. Why not, given their underperformance, look at them and take a fresh look?
Well, here's how you combat that. You have higher tracking error and own companies that are maybe not in the Mag 7, but have been beaten up a little bit, like Oracle or like Palantir, or you play cybersecurity theme in Palo Alto, which we think is the premier name in that. On the Meta thing, it's a perfect definition of you don't have to own everything, right? And I have issues with the CEO and there's some risk there with him. And he's not been able to demonstrate, in our view, who's next. Right? Think about that. And isn't he like UFC and jumping around? And what if he takes a hit the wrong way? You know, people give Humilis like key man risk. What happens to you, Belski? Well, I got this amazing team that can step right in. So we have to demonstrate that key man risk. I'm worried about that. So, but I do believe that if you take a look at what's happened in the private credit and private equity, here's the other great thing that I don't have to worry about making anybody mad at the big bank. We've been very vocally negative private equity and private credit the last couple of years.
Does it get much worse?
I keep going back to 2008. And we were head of U.S. strategy and sector strategy at Merrill Lynch. And we were the ones that were on the phone talking to these clients that had, back then, the alternative space in equities, hedge funds, right? And we were on the phone with some of these big clients who are like, Brian, what do I do about this hedge fund? And I had a fiduciary responsibility. And I remember back in the day, remember the BlackBerries?
Yes, of course.
Did you memorize your keyboard on the BlackBerry? You did.
I mean, you just knew it.
You just knew it.
So keyboard.
So, and back then you could do the BlackBerry to BlackBerry messaging.
Yeah, BBM.
Yep.
I know.
Okay. So I remember on with a very big, it was a celebrity client and her husband. Her husband was one location. She was in Hollywood. The broker was in Boston. The business manager was in LA. They're all in the line. And this celebrity said, Brian, I see you on TV and that's why you're out here and I trust you have a kind face. She said,
sorry. She's right. Okay.
So she could tell me what to do. My husband went to Cash in March. He's in Montana with our guns. This is, swear to God, story. Why didn't I sell this hedge fund? September of 2008. And I'm getting a BBM underneath here from the broker in Boston saying, don't tell her to sell, don't tell her to sell, don't tell her to sell. And I said, you need to sell.
You did tell her to sell.
Well, I saved her 40%.
Yeah.
Do you think the broker was very happy? No. But so, okay, where are you going with the private equity, private credit? I think the private credit, private equity stuff is very sexy. It's very exciting. High net worth, home office people can look at these fancy valuations and lockups and all this kind of stuff. And this company, I'm going to be early on, right? I'm worried that there's been too many people chasing that and not really understanding the breakup value. When you break up with somebody, it hurts. It's painful. And It's for me, it's just reminiscent of 2008. So
is it as bad? Because like we hear that, that's a scary thing to say. Is it as bad? Isn't it more ring fenced?
I don't know about that. I don't know about that. But here's the positive spin. You ready?
Yeah, always.
I think this is going to be very positive for small mid-cap companies.
Why?
Because if you're an investor looking at this very exciting private equity, private credit thing, I'm early on in this company. Well, the small mid-cap universe in the United States, if you take a look at you add up all publicly traded small mid-cap companies in the U.S., they are smaller than the market cap of Apple. So people go, that's exciting.
Yeah.
Right? Because you can have make stock picking ideas and grow a portfolio that way. So what does that mean for private equity? If you're really comfortable with a particular type of asset class or story in terms of small cap, now you've got a smaller mid-cap company in the public marketplace where they have to report numbers and you can get information on. And oh, by the way, there's this thing called liquidity. So if it goes the other way, you can get out. That's the big thing in private equity and private credit that I think caused people to have this consternation recently. And so AI focused, I think in the public marketplace of small mid-cap, I think over the next 10 years, that's a place that can really flourish.
Do you think any of these asset managers that have some of these products that have definitely been under pressure have been unfairly pressured?
No.
Or you wouldn't go there yet to like the Apollos and the KKRs of the world?
No, we sold all of our Blackstone. We bought Blackstone at our former employer when interest rates were going up big in 2022. That's when you want to buy those. You want to think contrarian, different, right? We love it longer term. We think that they're actually great managers relative to some of the others, but I just think that there's too much individual pressure on that company. We saw what happened to the big banks like JP Morgan and Wells and Citigroup, and that was kind of and then you started to worry about systemic risk and all these kind of things. And when anybody starts talking about systemic risk in 2008, and they're over their skis, man. I was working at Merrill Lynch at the time. That we're not there yet. We're not even there yet. So just because credit spreads may have gone up a little bit doesn't mean that we're heading into this 2008. Everybody jumps to that conclusion right away. But there is, I do believe, specific risk to some of these more concentrated private equity and private capital companies.
Which has affected the big banks, which you do own. So it sounds like maybe that's an area you think is unfairly punished.
We think the banks are very unfairly punished. In the United States, we have 600 publicly traded banks and 4,000 banks overall. I know. It's crazy.
It's wild compared to Canada.
Canada's got 6.
Yeah.
And so I believe that the big banks and the really small banks are going to continue to flourish. Why? Big banks because of liquidity, and they have the ability to continue to grow through their multi-divisional assets. Same things that I was complaining about before. So whether or not it's the private side, the commercial side, the institutional side, or the wealth side, they have scale, right? Whereas the small banks, at the end of the day, this is an amazing business, but the small banks are garnering volumes from especially the mid banks and the big banks because of the relationships, right? So the U.S., we're not really trusting the man now. We're not trusting the big banks. So the smaller mid-cap banks in regional areas are doing much better from a volume perspective in terms of commercial loans and even wealth relative to the big banks. I think it's the middle ones that are in trouble because they can't be small and they can't be big. So I think that they're going to benefit from deregulation and consolidation.
And I think the North Star, it turned out for the markets last year. Tariffs grabbed the headline, but the North Star was earnings growth. Ultimately, there was earnings growth for the S&P 500. And now we've got potentially a price shock with crude and other things being disrupted because of the Iran war. Even if there is a ceasefire, there's a price shock. But I still see earnings estimates of 17%. Going up. Is that the North Star?
Yes. And that's really defining the earnings-driven market. And the other thing about the U.S. relative to other markets is the discernibility of earnings and the consistency of earnings. We're not seeing earnings like this. They're pretty steady. And when you're owning an investment, don't you want it kind of steady, Eddie? You don't want this. And I think that's part of what Canada is going to have a short-term negative the next couple of years is more cyclical earnings. I think earnings could be potentially peaking in Canada, especially given the great year last year.
I want to talk quickly before we get into the mailbag because we have a lot of stock-specific questions that now I can finally ask you. Yes, can't wait to get into it. But first, just tell me quickly why you're neutral on gold. Neutral or underweight?
Neutral.
Neutral. Why?
Well, in our former life, we went positive gold in 2022.
Good time.
Yeah, and everybody hated it, right? Now everybody loves it. That makes me worried. Anytime you see gold on a year-over-year basis that is 2 to 3 times standard deviation of the average performance, it underperforms for the next 2 years.
That's just historical.
That's history, man. It's just math. This year, heading into this year, it was 4 times standard deviation. And so I'm trying to make friends and influence people. We're in the Canadian market. I mean, I'm hopefully a voice of reason. Doesn't mean you sell all your gold stocks. It just means just be careful. Don't be chasing it just because. I don't know if I haven't been in an Uber lately up in Canada because I've been worried it's been too cold up here. but last time I was here in January, all they want to talk about was gold. And so that was actually
your tell.
That was also a good tell.
Talk to me about energy because that is a sector that sees a lot of whipsawing because of crude prices. I mean, the day of the extension, crude fell, these energy stocks fell. Before that, they'd been on before the war, they were on a tremendous run.
Well, in Canada, if you look at like Suncor versus CNQ has always been more correlated, meaning related to the price of oil versus Suncor. Suncor is bigger, more diversified. We love Canadian energy versus the U.S., always have. And the reason is that we believe that Canadian management teams do such a better job managing the company. Look at Enbridge, look at Trapp, Suncor, great companies relative to, Exxon and Chevron have been trying to buy things and buy assets because of their growth, and dividends are great. And we own some of those companies. But at the end of the day, we have always favored Canadian energy over U.S. energy.
And do you continue to, even if oil prices come down?
Yes.
Explain to me how those stocks still work.
Well, Enbridge, in terms of its business model, and then getting more involved with the U.S. and being less correlated with the price of oil versus the U.S. The way they run their business is a little bit more aggressive, and you've got the refiners, you've got the services, and you've got the drillers. Drillers need that higher oil. Right. So from a correlation perspective, when you start to see the year-over-year change in oil turn negative, which it's probably going to within the next few quarters, because our view on rising oil prices is demand destruction doesn't happen in 3 to 6 weeks, Amber. It happens in 6+ months. So we can get nervous about things at the pump, and I know it's terrible, but that really starts to impact your bottom line well more than 6 months out.
We have one electric car and one gas car.
Really?
And we have not driven that gas car in the last couple of weeks. At least so I don't know what Tesla is doing, but maybe it's a nod for some of those EVs. I feel.
No, we own Tesla.
You own Tesla. Do you like it?
I do. I think.
Yeah, it's down. It's down.
That's okay.
It's okay.
Tesla skewed the performance of the consumer discretionary sector last year because remember, Amazon did not have a good year. So it's Tesla and Amazon in the consumer discretionary sector in the U.S. Tesla had a good year. So this year it's been a little bit more dicey. We think watch Tesla with respect to the SpaceX IPO.
Right, yeah.
I think ultimately our view is that they're going to combine the companies.
They're going to say that again?
Combine the companies.
They're going to combine the companies. Okay. Let's see what that does.
Another brash prediction.
I like that though, and we hold you to it because we're going to have you back. Okay, let's go into
can I come back and can I come back now? I think it's been like 10 months.
It's been 10 months. Yeah.
Can we come back like
sooner?
10 months?
Okay, yeah, sure.
I don't know.
9 months.
Not after the feedback from this thing. Belsky's arguing about international markets. He's always bullish and blah, blah, blah.
They'll like what you said about Canadian energy though, so I think I
believe it.
I know.
I love Canadian consumer companies too. I love them.
Okay, let's talk about that and dip into the mailbag. Okay, so you love Canadian consumer companies. I think we can still call Lululemon one of those. We have got a question from ZR Vinos on Instagram. Do you still like Lululemon? A lot of tumult at the retailer.
I did. We took Lulu out of all of our tactical and all of our large cap portfolios and put it in value.
Okay.
Why?
Is it a value trap, though? How do you know it's not a value trap?
Great question. Oh, look at you.
Look at me.
You know what a value trap is? So value trap is, it's just math.
Something
You got a
that
P
keeps
and an
going
E,
down.
right? So you have a PE ratio, numerator, denominator. If the denominator goes down, meaning earnings, that's a value trap. That means the actual valuation goes up, okay? What we think, Chip Wilson's back involved. I think what I'm hearing in our research is that they're going to become more focused again on what they're good at, meaning athletic wear. And putting it in the store the right way versus you have to go hide. You have to go in there and look for stuff. So they're revamping that again. Make it keep it simple, stupid. So we really like to find companies that were former growth stocks that are broken operationally and buy them in the value portfolio. We've done it before with Google, done it before with Netflix in the past. We've done it before with Costco several years ago. It's obvious they're not value stocks for long because operationally they get their stuff together. And we think the same thing is going to hold true with Lulu.
Do you think it'll happen with Nike? The broken, pathetic stock that I own?
We owned Nike for a little bit in our prior life. We blew it all out because they came out with one good earnings. And that was before they started talking about getting more focused on the shoes again. I just didn't like their approach on how they were doing things. Target's another one that we like again because they really righted their ship in terms of value. Anyway, let's go back to Nike and also Lulu. So, I live in Minneapolis during the summertime because it's too hot in
Florida.
And so I talk to everybody. And so I see these young people in the elevator and I'm like, hey, I see you have aloe on. They all love aloe, right? They love aloe because it says aloe here. And then I said, what about the balling? And the gals look at me like, how do you know about the balling? I goes, I have a daughter. She told me that was a cool word.
This is like the pilling, the fabric
pilling,
pills.
pill, yeah.
The balling.
Pilling, balling.
Pilling, yeah.
Pilling, yeah, pilling. Thank you. Same thing. And I said, what about Lulu? Well, they used to do that too, but not anymore. I said, you're going to come back to Lulu. I'm telling you, you're going to come back to Lulu.
Look at you converting them one elevator ride at a time.
Exactly.
Okay, so still likes Lululemon. Let's switch a little bit into some of these heavy equipment companies. We've got a question from Sid Portner on Instagram. In a dry, warmer world, do you like any agriculture plays?
Yeah, no, he also kind of asked about ferts, as we like to call them in Canada.
Yeah, the fertilizers.
And we played that space before. I think I'll take the derivative of that. I think farming is going to be, in agriculture is going to be really important going forward. And so that's why we've taken a look at companies like Deere and Cat, Parker Hannifin, but also AGCO, which is it was more of a mid-cap company that we think has good earnings. And the good thing about those types of machinery, agricultural companies, that you want to buy those companies when return on equity is bottoming and recovering. And we're seeing those trends in those types of names.
Deere and Cat have had phenomenal runs. And it's interesting to hear you say that's happening at a time where their return on equity maybe was struggling. So does that create a situation where, on a chart, it looks like a lot of great stuff has already happened, that you think it can continue?
I think it could continue, especially given their market share and given how they've done in the manufacturing side. And they have incorporated some AI in their manufacturing side, but they've tightened up on how they're making things.
Yeah, I was going to ask if these are almost being looked at as like the next wave of AI stocks.
I think people tried to do that, but there was kind of a hard sell on how literally the connectivity.
Yes, yeah. Okay, so you like those stocks. One question we've got on the telcos, this one coming from Dylan on Instagram. Brian's the best.
Oh my gosh.
That's it. That should be the end of the question. No, I know he likes Quebecor, but what's your take on Telus?
I think Telus is the best of the other big telcos. Rogers has had its issues. Bell's had its issues. Bell is in the process of kind of really reconfiguring how they're doing their business, focusing on the broadband and all of that. We like that longer term, but Telus has been the steady Eddie through all of this. The telecom business in Canada is very different than the communication services in the United States. So it is the true old-fashioned telcos, where in the U.S. it's AT&T, Verizon, and T-Mobile.
So let's talk about Telus, because it's been under pressure. Its dividend yield is 9.5%. New CEO, former CIBC CEO Victor Dodig, is starting this summer. And the number one question for investors is he going to cut the dividend? How can you say Telus is the best when that kind of threat is looming over?
Well, I think it's really smart bringing him in, because remember what he did at CIBC was he retrenched and said, we are really going to focus on Canadian growth. We're going to focus on what we're really good at. I think he'll bring more focus on that. Now, we're watching Telus, obviously, just like we watched BCE in terms of its dividend. We saw that they've finally succumbed. So we'll keep watching it. But then I think from our perspective, and being contrarian, I think it's a good time, given where cash flow is there and where their balance sheet is. I think they'll be okay.
Okay. And actually, BC it was slow to turn around after its dividend cut, but over the last year, it's up 18% compared to Telus. So
yep.
I guess that shows there can be life.
There can be light
after
at the end
a
of the
dividend
tunnel.
cut.
Right.
Are you taking a view on whether they cut the dividend or not?
Not yet.
Not yet. Okay. Another consumer stock question that we had is from Cardi on X on Aritzia. Now, this one, I'm sure whoever you're talking to in the elevator, they're decked out head to toe.
Aritzia is a super smart company. They've really managed their expansion to the U.S. smartly. I think their product is amazing. The way that they treat the customer is amazing. And just their growth trajectory. I don't believe that Canadian people own enough Aritzia stock. I don't think they do.
That's probably true, because it's not the style of investment. And it's a big company. It's $14 billion. But yeah, we tend to own banks, energy, gold, maybe some rail stocks in there. And I imagine that clothing is seen as too fickle.
Well, I think, going back to my prior experience and prior job, I first came up here. Canada Goose was the big one.
Yeah.
And everybody wanted
that work out.
And yeah, so I think they may have a little bit of issue there. Plus, look at Dollarama is such an amazing company. Couche-Tard's amazing company in terms of the consumer space. Even Canadian Tires, to me, it's a great company. It's cool.
Those are all staples. Like Canadians can get comfortable with staples. It's like the discretionary spend. Aritzia is like a discretionary.
Yeah, well, what's interesting about Dollarama, they've raised prices how many quarters in a row? But I'm saving money because I'm going to Dollarama. It's a great company. But I think from a stock picking, product, service, operating performance side of things, that's why we've owned Aritzia for, oh my gosh, not 10 years, maybe 8 or 9.
Oh, wow. Long-term holders.
Yeah.
Oh, so you're sitting on a huge gain.
I am.
For those listening on audio,
I bought the stock.
Smiling, nodding.
So I think it was, 7 years. Because it's 2026, right? So I think it was 2018, 2019. I was walking down Bloor Street right over here where the Aritzia is.
Yeah.
And I walked in there. I'm like, whoa, what is this store? I didn't know anything about it. I'm like this dumb guy, right? And I looked around and I saw how they were interacting with their clients. And I saw the product and how they displayed it. And I did a little research. I'm like, I'm going to buy this company. So that was early 2019.
Yeah. So since 2018, up 1,000%, almost 1,000%. You'll take it. All right. Well, let's see if we can find more of those in the portfolio. A few more questions in the mailbag before we get into your top ideas. We have a question about airline stocks, specifically Delta, which is very timely because it just reported. But looking at Delta in like kind of a broader, big picture view, is Delta an example of a stock of the airline sector finally being investable? Kind of cruel.
We have owned Delta now for several years. Growing up in Minnesota, we flew Northwest Airlines. Say Northwest late at best. And Delta merged with Northwest. A lot of the people that worked at Delta were former Northwest people. Delta by far is the number one airline in the world, period. And several years ago, it might have been 10 years ago or so, they bought a refiner. Mm-hmm. So they refine their own oil. And so some of that's lost because we want to.
I mean, they're still taking a hit on crude.
Of course.
But yeah,
but from pricing perspective, from capacity, for the way that they treat their clients, Delta by far is the best. We also own United in our small mid-cap portfolio. United's done very well as well. So from an airline perspective, Delta is the cream of the crop.
Now, what about the heart of the question about whether it's a long-term buy and hold? Because even if you look at the chart, it's such a messy chart, very volatile. But to your point, I mean, Delta's it's business, first class business. I think now is it bigger than main cabin? Corporate sales are growing by double digits. Like, does that create some stability?
I think it does. And it's becoming less cyclical, dare I say. I don't want to say it's different this time, but the industry itself has taken out a lot of capacity anyway. And from how Delta's spot in terms of how it fits into the industrial sector, I think it's become an increasingly important part of the industrial sector. Now, is it a buy and hold like Waste Management? Waste Management is a perfect Canadian stock, right? Because they pay dividends. They've never cut a dividend. They just continue chugga. That's an amazing company. We've owned it for a long time. That's a classic industrial buy and hold, just like Waste Connections is. Is Delta quite there yet? I think it has some more work to do, but we've owned it for several years.
Our final question is on the home builders, specifically KB Home. Been a bit of a heartbreaking sector for the last couple of years. And I think people are just waiting for some sort of sign of life in the U.S. housing market. And rates have not really been there to deliver that.
Rates have been the big thing, excuse me, and especially this year. KB Home is from a fundamental perspective, still one of our favorites. We've owned Pulte for a long time as well, KB Home in our small mid-cap, and obviously we've had a tough year. But when we take a look at how that company is managed and how they're going to facilitate that inventory is coming back on the market, and they're ready. It's just a matter of mortgage rates have to fall. So affordability is not great because of where mortgage rates are. But at the end of the day, if you do believe that we're heading into a more stable economy and inflation, given what's happened here recently, will roll over. Inflation goes up like an elevator and down like an escalator. And so that escalator is going to start tipping over, we believe, once this malaise and the conflict in the Middle East gets going.
Do you have to be a little bit more patient?
You do.
There could be more downside here?
I think so, especially given where mortgage rates are. That's really going to be the linchpin. But given where the strength of where KB Homes is in the United States and where the growth markets of the Southwest, the Northwest, and the Southeast, that's really where they're going to garner a lot of their volume.
I didn't get a chance to ask you about this, but about the rate, your rate outlook. So much of the enthusiasm coming into 2026 was about Fed Chair Jerome Powell will be out. The next chair is going to be super dovish. And you can put the Iran conflict in there as a complicating factor into whether or not we'll get rate cuts. Does your outlook hinge on getting rate cuts?
No, and we don't, we never relish when people lose their job or changing jobs. I mean, I think that's, it's terrible. But, our view for a while has been that we think that the 10-year treasury is going to be settling into this 350 to 450 range for the next 3 to 5 years. And we've seen lots of volatility the last couple of years with first Liberation Day, now the conflict in the Middle East. And so can we just settle down a little bit? And I do think the inflation side is probably going to be the thing that is going to help trigger that. I mean, we're going to have a drop in inflation versus a spike in unemployment. And remember, the Fed has a dual mandate. I was going back and reading, and I've always self-criticized myself and go back and look at where I've been wrong or whatever. And I looked at a note from 2011, and I was writing this note during remember 2011 was with the Tea Party.
Oh, Tea Party, yeah.
And I called it the stupid committee because they had the super committee. In print, I said the stupid committee. And we had this big pullback in the fall of 2011. And I'm like, we need to get things going. But can we just have unemployment start to roll over from 12%? Think about that. That's perspective. We forgot about that. So I think now that we've been kind of numb to having this
4%
or 5% unemployment. Now remember, unemployment is the laggingest of, if I just made up a word, of all economic indicators. People fire people at the end. They don't fire people in the beginning.
And I mean, I don't know if you can make any decisions based on the jobs data coming out of the US right now. I mean, it's like the Canadian jobs data is like throw a dart and you have just as good of a chance. I feel like the US is becoming like that. Post-pandemic, the jobs data has been all over the place.
I think, again, that's a lagging indicator, and it's something that we haven't put a lot of weight into, but we're letting the bond market tell us.
Okay, let's get into your high conviction ideas and dive into Pro Picks.
Let's do that.
Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, this is what you love, so we're going to get ready to pound the table, but not actually because it'll affect the
I know, we don't. Listen, this is all about, we're going to keep it classy.
Keep it classy. Okay, the first one is Costco. You go first, and then I'll go.
The retort?
The retort. I've got my retort.
I'm going to tell you what the retort is first.
Obviously, it's easy.
It's expensive. Everybody owns it.
Do I talk like that?
No, I'm just mocking you.
Okay.
Costco is a top 25 company in the world. Boom, drop the mic. Think about this. They're super smart in how they expand. It's more about scarcity than capacity. We are sitting in line for gas right now at Costco because it's cheaper than everywhere else. It's a racket. They make their money from subscriptions. And we have now trained America and North America to buy stuff at Costco. Even though, like I'm a single guy, I got the condo in Florida. Do I go to Costco and get the cases of water and cases of Diet Mountain Dew and I used to drink pop? No. But everybody else does in my building because they're all retired. So Costco, we love Costco. It should be a core holding. I'm telling you, it should be a core holding of every North American client in terms of their growth portfolios.
So let's go back to it's expensive. You're paying for that execution 50 times.
You get what you pay for.
Get what you pay for. Now, there's two ways that can be a problem. One, even the slightest miss can be aggressively punished. But the other is that it just doesn't move higher. And that, it's back to where it was in June of last year. So it hasn't done anything in the last couple of months. And so valuation at best can be limiting. At worst, you can hit an air pocket.
There could be some industry and sector dynamics there because a lot of the naysayers, the bears, let's get negative, let's go buy consumer staples, right? So are you going to go buy Campbell's Soup, Philip Morris, and Kimberly Clark?
They're so cheap. They're so down and dirty and cheap.
They're down and dirty for a reason.
You don't
so you'd rather go smoke cigarettes and Philip Morris or go to Costco and stand in a line or get one of those delicious hot dogs and a piece of pizza while you're walking around. That's what I do. But Costco is a consumer staple stock technically. And if you're getting worried about the market, that's why you've seen so much rotation into these cheap names. They're going to come right back out of them again.
Okay, so a core holding in Costco. Google, the second one, Alphabet. For me, the one that got away.
They're sneaky, man. Let me ask you a question. Are you still using search?
Sometimes, yeah.
Okay, that's the right answer. So us old people, we don't ChatGPT. Remember a year ago, we're never using search again. ChatGPT, Google got crushed. Well, right before then, people kind of missed that. Sergey came back. Eric came back. In terms of their former CEOs, they made a deal with Apple. It's kind of like Coke doing a deal with Pepsi, right? Smart, okay? So way oversold. We added to our value portfolio then. We still own it in most big cap portfolios because we think Google is the creme de la creme in communication services, which benefits from the thematic 3 C's: cash, content, and consolidation. Now let me go further. I think if you take YouTube out, YouTube is bigger than Netflix. The YouTube machine is a fantastic cash generator. And I believe that all major league sports in the United States within 5 years are going to be streamed off the networks. And Google's going to be a big winner. Netflix can be a big winner. Amazon's going to be a big winner.
So this is it's a content play in addition.
It's a content play. It's a management play. They're ahead of the curve in terms of where they've been very smart and diversified in terms of their AI and what their software is doing. They haven't gotten over their skis. They're not trying to be what somebody else, like Meta's trying to make chips. Come on, man. Google knows their business.
So, I mean, this is a Mag 7. So you're cherry picking within the Mag 7
Correct.
Where your conviction is.
Correct.
And Alphabet is still there. And, well, it's not as cheap as it was, but you could still say, I guess it's cheaper.
You keep talking about cheap and valuation.
Well, give me an education. Give me an education.
You don't buy stuff because it's cheap. You buy stuff because it's working. Valuation is the world's worst predictor of forward performance, especially on markets. But valuation, you got to be careful. You want to look, the most important thing is, how is this company operating? What is their company management? Do they have a product or service in the addressable market going forward? Yeah, it might be expensive. You would have never bought Shopify. You would have never bought NVIDIA. Yeah. You would have never bought Amazon.
You can buy NVIDIA. It's cheap.
Yeah, you would have never bought Amazon.
Yeah.
And so these are companies that you don't just buy because they're doing great or because they're cheap. You look at names like Philip Morris, cheap name. Well, okay, that's great.
Yeah, but you run a value fund, so obviously you do think about it.
Of course we do, but we look at names in the value portfolio that have debt to equity below 1, earnings above the market, PEs below the market. So by the way, you got a lot of financials, you got some healthcare, you got some tech in there now, by the way, and you have some bottomed out discretionary and staples like Target.
Okay, so we're getting some bonus names. So Costco, Alphabet, Apple. Why do we want to own Apple?
It's the greatest company in the world. Think about
Say it louder. Say it louder. Don't
greatest
whisper.
Company in the world. Think about this. Apple's got more cash on the balance sheet than the country of Canada. Number one. Number two, when all of this stuff was going on with AI, they were kind of sitting back, being real, and everyone was, well, we're not going to buy Apple because they're not investing in AI. Yeah, they are. They're just being really quiet about it. They've got the best product line, got the best management. They've been very, very smart. And we love Apple for the consistency of it. We love it when people are negative Apple. That's when you buy. I think you had this really smart guy. I think it was, Warren Buffett came out last week and he goes, I wish I would have never sold Apple.
But he is selling it.
Not anymore.
No, not anymore.
Well, he's technically not because he's not in charge.
Not in charge. And he himself has quite a healthy cash pile. Yeah. Which I guess we'll all wait and see what the company does with it. But sticking with Apple, it's what is the play? It's just iPhone cycle after iPhone cycle. It's
just steady Eddie. They're going to win in technology. I think Apple too.
I don't know. Their AI offering is terrible. I still can't do anything on my phone. Like, is that what we want from our tech stocks?
Steady.
Like time?
You want steady Eddie. You want consistency. iPhone cycle, new products in terms of what they're doing on the service side. They've righted their ship on Apple Music. They've improved their Apple Music offering. That's part of the reason why I bought Spotify all these years ago, because Spotify was actually better than bonus pick. Spotify. Spotify was actually better at podcasts and music. Yeah. And now Apple's kind of caught up.
It's true. We have actually.
And you can merge, I'm sorry for interrupting. No. You can merge the songs together now, like a DJ on Apple Music.
I noticed.
If you notice that
happening, I'm like, oh my god,
it's cool. Like Spotify, you could do that. You go Taylor Swift right into Sabrina Carpenter.
That's right.
See how I did that?
I did. Yeah. You're so down with the kids. The thing too about Apple, I wonder if like they're playing chess with AI as much as I just told you their offering is terrible, because like they're not fine. You say they're spending, but they're not becoming this CapEx heavy business like Meta, your favorite punching bag.
Today, my favorite punching bag. Yeah.
And I wonder if like that's the right thing to do. Like let everyone else spend. Let's see what comes out, and then whatever is good, we put that on our phones.
I think so. I think that's the right play.
Okay. All right. So those are the three plus some bonus: Costco, Alphabet, Apple,
Spotify,
bonus. Anywhere you get this podcast. Which we're also on.
Which we just named them all.
We're also on YouTube.
So there you go.
Brian, always a pleasure. Thanks so much for joining me.
It's not going to be 10 months, is it? This is pressure on. So maybe like 9.5.
Jillian, we book out pretty far, right?
So we'll see you in 2028, Belski.
No, we'll see you. We'll pick a summer month. So you can see that we do get some nice weather here from time to time.
Thank you.
Okay, thanks.
Honestly,
so much.
by the way, everybody roll with this, okay? You have been so amazing to us through the years. You have. And we did something in the US when we did a panel. Remember that?
Yes.
And you were so gracious and so amazing. You've been great to us as a brand. And now supporting Humilis means a lot. It really means a lot. And the reason why I'm here doing this podcast is because of you and your support. So
nice.
Please roll with this.
I'm going to roll with it.
Right.
Thank you. All right.
Thank
so
you.
I guess we'll get them in. We'll get them in a few months, Jillian. See, sales.
Sale, gotta
Still
sell.
got it.
Sell.
Thank you very much.
Thank
That's Brian
you.
Belski joining us of Humilis. Don't miss our next episode. We're talking North American large caps with John Zechner. You can email us questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.